Hello, everyone. This is Douglas Auclair, owner of Logical Graphs LLC, known online as JOF. And today we're going to be talking about how to grow zero point 0.4 Bitcoin into something more substantial using Benqi leveraged approach. There are inherent risks of doing this, um, and I will go over those risks at the end of this video, and I will also include links to the protocols involved. Um, And there's trade-offs. So, for example, if I kept my zero point 0.4 Bitcoin on the Bitcoin blockchain, then it would grow in value over time as Bitcoin grows over value in time. And to demonstrate, I will show you its growth over time. So if we look at, I started purchasing Bitcoin back in February, at the end of February, and I made purchases of uh, $1,000 per purchase. So dollar cost averaging. And you see the average price of the Bitcoin in this column here. So I started purchasing Bitcoin at $93,000. Bitcoin's value went down over time. Um, down to $78,000, $76,000 as I kept purchasing. And then Bitcoin's value has gone up above $100,000 again. We're back to around $110,000 per Bitcoin. So the average purchase price of Bitcoin was around $86,000. And the current price is around $109,000. So if we look at um, the valuation of Bitcoin I had approximately $45,000 worth of Bitcoin or 0.42 Bitcoin. Um, and I spent $36,000 to get it using dollar cost averaging. So if I simply kept it on the Bitcoin blockchain, then I made approximately $10,000 in va value appreciation of the Bitcoin itself. However, the Bitcoin amount has not changed over time. The Bitcoin is just sitting there. So I'm looking at growing the amount of Bitcoin I have over time, and I'm going to be using Benqi Finance to do that. Let me introduce you to Benqi Finance. Benqi Finance is a market on the Avalanche blockchain um, that has it's a money market for cryptocurrency. And as you see, as you deposit Bitcoin into the money market, Benqi Finance, you get zero point 0.2 uh, average percentage growth, annual percentage growth of Bitcoin. So not very much at all. And the rewards are 1%. Not tremendous amount, but that's a 1% growth over time of yields and growth. Um, so what I did was I deposited my Bitcoin into Avalanche. Now, in order to do that, I had to get my Bitcoin off the blockchain, the Bitcoin blockchain, and onto Avalanche. And the way I went about that was I went through Osmosis. Osmosis has an alliance with Bitcoin, with no Noble um, or Nomic, in that there's hardly any fees associated with depositing Bitcoin onto the Bitcoin blockchain or withdrawing Bitcoin from the Bitcoin blockchain. You see, the total fees is $2 for withdrawing $44,000 of Bitcoin or the zero point 0.4 Bitcoin from the Bitcoin blockchain onto Osmosis. $2 is not very much at all for fees, particularly with working on the Bitcoin blockchain. And then what I did was um, I moved the Bitcoin from Osmosis to Ethereum. And the reason why I did that was on Avalanche, Kyber Swap allows you to trade cryptocurrency from Ethereum or from other blockchains to Avalanche or other blockchains. And so I moved the wrapped Bitcoin from Ethereum to Avalanche. Now look at the fees associated with this. I'm trading zero point 0.2 Bitcoin on Ethereum and I'm getting 0.1989 Bitcoin back. That's almost parity if you look at it in an amount of Bitcoin. But if you look at a dollar amount, I'm trading $21,870 worth of Bitcoin, and I'm getting $21,780 worth of Bitcoin. So approximately there's a $90 fee on $20,000. That's less than 0.5%, but that's still a $90 fee. So the reason why I didn't do zero point 0.4 was the fees were much more. So I did zero point 0.2 and zero point 0.2, and then I got that onto Avalanche. Now that I have the Bitcoin on Avalanche as BTC.B, what I did was I deposited the Bitcoin into Benqi and deposited both sets of Bitcoin into Benqi. Um, And so as we look at Benqi, you see that my Bitcoin position was zero point 0.4, and then I borrowed zero point 0.2 Bitcoin. Why did I borrow zero point 0.2 Bitcoin against the Bitcoin I deposited? Well, as you see, um, the yields are 1% of the Bitcoin that you deposited. The the loan percentage is about 1%. So borrowing zero point 0.2 Bitcoin and then putting it right back into the supply side gives me 1% on $60,000 worth of Bitcoin as yields. And I'm getting charged 1% on the $20,000 of yields that I'm charging. So I'm basically making 1% on $60,000 and I'm losing 1% on $20,000. So 1% on $60,000 is $600. That's approximately $2 per day. 1% on $20,000 is $200. That's approximately two-thirds of a dollar per day. So I'm basically making $1 and 30 cents per day based upon this Bitcoin position. Now, this is the loan amount is growing over time, and the supply amount isn't really growing so much over time. So my plan then is to take these yields that are generated from the Bitcoin that I've deposited, and they're mostly in AVAX, to claim those yields and then go over to Kyber, swap the Avalanche for Bitcoin. So my yields are two AVAX over an accumulation over a period of days. A dollar's worth of AVAX is not two AVAX. And then swap that to Bitcoin. That's 0.000 45 Bitcoin. Then I go back to Benqi and I repay the Bitcoin that I borrowed. So let's say I have 0.0045 Bitcoin. I repay that amount. That's approximately $50 worth that I'm repaying. Um, that's not very much, but as I repay the Bitcoin over time, the value of the borrowed amount goes down and the supplied amount goes up by 0.2%. So it basically stays the same, meaning that I started with zero point 0.4 Bitcoin. And over the next 100 days, when I pay down this completely, I'll have zero point 0.6 Bitcoin. So if you iterate that over, then I'll have zero point 0.6 Bitcoin with no borrowed amount. I borrow zero point 0.3 Bitcoin, repeat the process, and I would have deposit that 0.3 into here. I would have 1 Bitcoin on the supply side. When I pay down the zero point 0.3 Bitcoin on the borrow side with the yields that have accumulated from that deposited Bitcoin, I will at the end of the year have 1 Bitcoin from zero point 0.4 Bitcoin. Okay, so that's how you grow zero point 0.4 Bitcoin to 1 Bitcoin over a period of a year. In this is 1%. This is simply 1%. The risks are different by this approach than with trading. With trading, you have the potential to lose the amount that you trade, and you can lose it in an instant. The risks here are very different than trading. One, Benqi is its own protocol, so you're giving up your keys of the Bitcoin by supplying your Bitcoin to the Benqi protocol. Benqi now has that Bitcoin and is holding it in your name. The other issue is with smart contracts. When you remove your Bitcoin from the Bitcoin blockchain and put it into another protocol, let's say GMX, um, they recently had a scandal where they lost millions of dollars worth of liquidity for their investors because of smart contracts. Benqi also uses smart contracts. If somebody exploits a weakness that may be present in a smart contract, you have a potential of losing your cryptocurrency because of a smart contract manipulation. That's another risk associated. The third risk is liquidation. So as you see, I am borrowing 0.24 Bitcoin versus 0.66 Bitcoin. If we look at the market for Bitcoin, the collateral factor is 69%. I could borrow up to 69% of the amount that I supplied. 69% is more than 0.24, but I'm going with zero point 0.5 by keeping it safe. But if you borrow more Bitcoin than the collateral amount of the amount that you supplied, then you run the risk of getting liquidated. Meaning that if you have multiple positions of supplies and borrows and you don't pay attention to what's going on, then the possibility of variability in the marketplace um, could cause that you lose your supplied Bitcoin due to liquidation activated because of that differential, that the collateral amount being exceeded. So you have to be cautious as an investor using leverage to ensure that your leverage position is more than adequately covered and more than adequately covered on various market conditions. So if the market goes up or the market goes down, you want to make sure that your leverage position is covered. This isn't like um, a leveraged markets where you're running futures at 50x or 100x or 200x. These leveraged positions are sensitive to the market, but since I'm borrowing Bitcoin against Bitcoin, if Bitcoin goes up, then Bitcoin goes up. If Bitcoin goes down, Bitcoin goes down. So the borrowed position is always going to be a subset of the supplied position, given this scenario here, where I supply Bitcoin and I only borrow Bitcoin and grow my supplied position using the yields. This is a very slow moving process. Like I said, it'll take a year for me to one clear out the borrowed amount twice so that I have 1 Bitcoin on the supply side. Once there's 1 Bitcoin on the supply side, the yields continue. So I can continue to grow the supplied Bitcoin by converting the yields from AVAX into Bitcoin if I so desire, or I could create a new levered position by borrowing more Bitcoin, depositing that Bitcoin onto the supply side, and growing that yield faster with the Bitcoin that I borrowed. The options are up to me at the end of the year what I choose to do. But zero point 0.4 Bitcoin to 1 Bitcoin in a year's time using the Benqi protocol um, yields in a leveraged way by borrowing Bitcoin against Bitcoin to grow the Bitcoin supplied. I'm going to supply links in the description to show the Benqi protocol and the osmosis protocol. You transfer your Bitcoin or you purchase your Bitcoin in however way you would decide to do that. There are other money markets, particularly AAVE, um, and the granary and other money markets that allow you to do these kinds of things, so long as the supply side is giving you a higher rate of return than the borrow side. When the supply side is giving you a higher rate of return than the borrow side, this works. If the borrow side is higher, then this is working against you. Um, and if you manage to make it work, it would take you longer period of time, and you need to use larger amounts to get the same kind of results. So keep an eye out on the supply side rate of return and the borrow side rate of return. And also you need to convert the yields, first harvest the yields and then convert the yields to Bitcoin and um, burn down the borrow side to eventually a zero amount so that the supply side is all yours at the end of the scenario. Thank you very much.